Hi everyone, my name is Geena Bouché from Berkshire Hathaway, California Home Properties, and I am here today with the fabulous ladies from Prosperity Home Mortgage. This is Lynda Bernal and Darleen Vogeler. We are here today to bring you the most current information and give you a little confidence on how to make the best offer for the house that you're interested in buying. So with that, ladies, question number one, what home prices as the buyer can I afford, and what are my monthly costs going to be?
As far as what home price can you afford, we actually have to start backward by starting with what monthly payment can you afford. Then we can do backward math from there to figure out what price works.
Perfect, thank you.
So the monthly cost all depends on a few details. One of them is the price of the home, the other is your loan amount, and also what the costs include is your principal and interest, your insurance, your property taxes, and if applicable, your HOA. So that's what it includes.
Excellent. And so just a little teaser for hopping to the very end of this series, but I'm gonna ask you to answer, how do people actually get started with you? You guys are kind of the first wave of who I, as the agent, connect my clients to, because we're gonna need to know how much they can afford and moving forward, you know, all of the details that you guys are about to share with us. But how do we start this process with you guys?
Great question. The best way that someone can start the process is either with a quick phone call where we can get some information, and then we can even do some math and kind of get them started along the path of, okay, how much can I afford? How much do I want to afford? And then to actually get into the pre-approval process, which of course you need the letter in order to submit an offer. Then what they need to do is submit an application through the online portal. It's completely secure and there's no cost or obligation, and we start with a soft credit pull, so it doesn't even put an inquiry on their credit. And that way we've got accurate numbers. And the more accurate we can be at that point, the more accurate that they can be with you, and you can make sure that you're looking at properties that work for them.
Excellent. Next question that we're going to talk about is down payment. What do I have to have in hand for a down payment and for closing costs?
Well, it depends on the situation. You can do anything between 0% to 20% down or more. It all depends. So, but we do offer 0% for VAs and FHA, and then also conventional we can do 3%. FHA is also 3.5%.
And if I don't have 20% down, you're mentioning some of these lower percentages. How are there different loan programs that we can get, that you guys have access to get into my dream home now?
Yeah, there are. A lot of people think you have to have a lot of money down, and that is incorrect. Obviously, if you are a veteran or active military, then you can use VA, which is an awesome loan program with 0% down. You can use, as Darleen mentioned, you can use FHA. Standard FHA is only 3.5% down, although we do have an FHA program that allows 0% down. And then standard conventional can be as little as 3% down. So there are a lot of options for lower down payments. And another one for 0% down is to do something like CalHFA, which is California Housing Finance Agency, and that's a down payment assistance program, and in essence, they provide the down payment.
So when I'm thinking lower down payment, my brain automatically goes to higher monthly payments. Is that 100% true? And what is the balance that my clients or buyers are going to be looking for when they're deciding, do I want to put more money down or do I want to put less money down up front?
Well, what you're talking about is the less money you put down, the higher your loan amount. The higher your loan amount, the higher your payment. So you are correct. So if they do have the option to put more money down, maybe they have it, but they're not sure how much they want to put down, we're always happy to do math and help them find that happy medium. So they're putting down enough to get them to the payment that they want, but they're not putting down more than what they feel comfortable doing, so that maybe they keep some cash in reserve for, maybe they want to upgrade some cabinets or flooring or whatever. And we're always happy to do the math for them, because everybody's scenario is going to be unique.
And also another option are gift funds. So if you have a gift from a family member, we can use that as well. That's with most programs, we can do that.
Excellent. Yeah. So can you explain a little bit more about what PMI is?
Well, PMI is private mortgage insurance, and that is used when you have to put down anywhere under 20%. So if your loan to value, meaning your loan amount divided by the value of your home, is under 80%, or I should say over 80%, when it's over 80%, you will have private mortgage insurance in most cases. And that's all calculated based on your loan amount and the loan to value.
And is that dependent on how much loan you're taking out? Is there a specific percentage that PMI always is?
It's definitely dependent on the loan amount. Yeah, loan amount and loan to value.
Okay.
It's also dependent on their credit score and other things like that. So figuring out mortgage insurance when it's for conventional, which is the PMI, private mortgage insurance, there are a lot of factors that go into figuring out how much they will be paying. Whereas with FHA, the mortgage insurance, the factor is always the same. It doesn't matter what your credit score is or anything like that. So it does make a difference.
How long do I have to pay that PMI for?
If it's on a conventional loan, then usually if you don't refinance or anything like that, if you keep that original loan, it's usually until your loan to value, your equity position is at least 20 to 22%. So usually that takes anywhere from like 11 to 15 years if you don't pay additional principal at all during that time. With an FHA loan, if you put less than 10% down, which most people do, then you have that mortgage insurance for all 30 years of the loan.
Okay, and then you mentioned refinancing. So can I refinance out of the original loan to get out of having to pay that PMI after I close on the home?
Yes, you definitely can. And that's actually what we can help you decide when is the right time to do it.
Excellent. Yeah, and that kind of is perfect, because you're not just here to do the original loan, you're here to help your clients and my clients throughout the entire home ownership process, because they're always going to be building equity in their home and wanting to take it out if they want to update the kitchen or the bathrooms, and so you're here to help them the whole time.
Yes.
And you guys are so incredible at building that relationship and building trust and making people feel comfortable. So it's just really good to have the knowledge and the friendship that you guys end up building with your clients as well.
Definitely. And can I share an example?
Yes.
I have a client currently who is at 7.375% interest rate, and his payment is $8,061, and we can refinance him doing 6.25%, and his payment would be roughly $6,400. So his MI actually dropped from 677 with an FHA loan down to 166 with a conventional loan. And his payment, I forget what his payment dropped to, but overall savings is around $1,400.
That's
A
huge.
month.
A
Yeah,
month.
that's huge.
Yes.
Yeah.
And he didn't even have to put any more money down, and he's at an 89.9% loan to value. So he still doesn't have the 20% equity, but yet because rates are dropping, he's able to do that right now.
Amazing.
Yeah.
How long has he been in his existing loan for?
A little over a year.
Okay, so it can happen just as quickly as that.
Yeah.
And I think that's another reason why all of us agents are always saying, you know, you've fall in love with the home, not the interest
Right.
rates, but we're always so focused on the interest rates, especially with watching the news these days, and you really can completely change your financial situation. The goal is to get into the house, right? And then you can, with you guys and your help, you can change the financial situation as long as the market allows.
Yes, and actually late June of this year I had a client who was waiting for the rate to go lower each day, and it was. And then all of a sudden it started escalating come 4th of July, and after that it just, he was able to obtain a 6.625 interest rate early on in June or late June. By early July, when he decided he wanted to lock, and when he had to lock, he had a 30-day escrow, his rate was 7 1/8. So he lost out. So at the same time, you want to lock in when you know you feel comfortable with the payment, with the rate, because especially in this market that we're currently in, it can go up one day, down another. You don't know.
So in your 30-day escrow, let's say, and of course escrows can be shorter than 30 days, but at what point are they required to lock into a specific rate?
Just because of federal regulations, there are a lot of timing things that go on. So in general, about the latest that they can lock their rate during the process is about 7 to 10 calendar days prior to close of escrow.
Okay.
The biggest question we get a lot is, what if I lock my rate and then rates go down before my escrow closes? The thing is, in general, once you lock, you're locked. That's your rate. However, with that said, because we have seen some big movements in a short time in rates, and so if rates go down significantly during your escrow period and you've already locked, there is an option for us to float your rate down. So it's not a guarantee, but it is an option. So during an escrow, one of 3 things will happen with rates. They will either stay the same, they will go up, or they will go down. So 2 out of 3 of those would tell you that you should lock, because then you're protecting yourself. If the rate stays the same, okay, well, locking now, locking later, doesn't matter. If rates go up, you'll pat yourself on the back that, oh, okay, I locked right. So it's only 33% where, oh, rates could go down. But in general, rates have a tendency to come down like a feather, go up like a rocket. So the odds are always much, much higher that rates could go up during an escrow rather than coming down significantly in such a short period of time. So
It's better to pat yourself on the back for sure.
We're all hoping for that.
Yes.
yeah.
What are the pros and cons of buying points to lower my interest rate? And can you say a little bit more about what buying points actually means?
Okay, so the pros is that you'll have a lower payment, and the cons is that if you refinance or sell your property before you recoup the cost of paying for the buy down, or not the buy down, but to buy the rate down, because those are 2 separate things, then you can actually lose out on money. So you want to make sure that you do talk to a specialist, a loan specialist, to make sure that based on what your needs are, what your plans are in the future, that it makes sense for you.
So the client would tell you guys a little bit about their game plan with the house. Is this their forever home, or are they only looking to live here for 5 years? And then you would help assess what the strategies are for buying points.
Right, because the longer you have the loan, the more you're going to save on interest. So that would make sense. But just say you're going to have a loan for 6 months. Then typically, I mean, depends on how much you buy, the rate down. That doesn't make sense. So you want to make sure you definitely want to recoup the cost during the time that you are planning on being in that home, or keeping the loan at least.
Yeah, what points are is basically you're just paying additional closing costs at close of escrow to buy a lower interest rate. And that's kind of how it is. The way points are calculated is a little bit more complicated, and it changes on a daily basis, and it also is different for every loan scenario. But in essence, 1 point is 1% of your loan amount. So if your loan amount is $500,000, then 1 point would be $5,000. So that's why when Darlene is saying, okay, depending on how long you're actually going to have that loan or own that property, you may or may not have it long enough to recoup that, say, $5,000 that you paid at close of escrow for the lower interest rate. And that's why, again, every scenario is different. So we have to do math that's very specific to that person, that property, and then also, like she said as well, depending on what their plans are for the property. And we know that life changes.
Yes.
You know, you can't ever predict, okay, 5 years down the road, this is exactly where we're going to be, what we're going to be doing, how much income we're going to be making. But most people have an idea in mind that, okay, yeah, we plan to be in this house for 2 years, 5 years, 10 years, 15 years. And obviously, the way that they approach pain points would all be different based on those different time horizons.
Yeah. And so for those who maybe haven't heard of this before, or if you're trying to figure out, well, why would this apply to me or my situation, this can often be a strategy that we're going to employ when we're making an offer or negotiating on a house. So can you put together just a simple scenario for a buyer who might want to employ buying down points or negotiating that into the offer, as opposed to offering less money on the house and looking like a stronger offer?
Yeah, what I think you're asking is that in general, when we do the math, the difference between getting a credit from the seller, so offering, let's just say $1 million as the price, and getting a credit from the seller toward my closing costs, and then maybe using some of that to buy my rate down, to get a lower rate, versus asking the seller just to give me a lower price. Typically, when we do the side-by-side comparison, the buyer ends up getting much more bang for the buck with the seller credit and using it to buy down the interest rate, versus just reducing the price by, say, $5,000, $10,000, whatever. That, interestingly enough, doesn't move the needle much on a monthly mortgage payment, whereas reducing the interest rate has a huge effect on the monthly payment.
So the seller leaves the transaction happy because they didn't have to do a price reduction, and there's always a little bit of ego involved in that. And of course, you know, they need to make this the right amount of money for them to make the sale feel good for them. But then the buyer ends up benefiting because they're actually saving more money or not spending as much money on their interest every month. Right?
Exactly. It's much more of a win-win situation, and it typically costs the seller much less to do the credit than what it would if they did the price reduction.
Amazing.
Yeah, and let's be honest, how many people actually stay in their home for 30 years?
Yeah, the
Or
average
refinance.
is 7 years, actually.
Right.
The
Or
average,
refinance. Right.
yeah.
So it makes sense to go ahead and get the seller credit or to buy down the rate.
Yeah, that's a good point. Is there a type of financing that allows me to have lower monthly payments initially and then gradually it increases, thinking that maybe my financial situation will get a little bit easier in the long term?
Definitely. And just like we were talking about with the seller giving a credit toward the buyer so that they could buy down, do a permanent interest rate buy down, the seller could also give a credit to the buyer for something called a 2-1 buy down. The difference here is that's temporary. So the first year, the interest rate is 2% below whatever the actual rate is for the loan. So let's just say the rate on the loan is 6.5%. Then the payment that you would have as the buyer for the first year would be calculated at 4.5% interest rate.
That's amazing.
It's a big difference in your payment. And then the second year, it's 1% below that note rate. So that would be at 5.5%, which is still a significant savings. And then from year 3 onward, it would be at that full note rate of 6.5%. So basically what the seller has done by giving you that credit is subsidized your payment for the first 2 years. And that gives you time to maybe get that raise or get that new job that pays you more, or whatever you're thinking down the road is going to improve your finances.
Why is this not talked about more? This just feels like such a secret hack, but you know, like what's going on? Why don't more people know about this?
Well, to be honest, and we were just talking about this earlier today, back in the good old bad old days, which is early 2000s and way back, things like this, permanent buydowns, paying points, and temporary buydowns were very common. And then what happened was the big implosion, 2008, and then after that, for about the next decade or dozen years, interest rates were only around between 4 and 5.25. So they were pretty low.
Mm-hmm.
Most people didn't really think about paying points or getting buydowns. And then we had COVID and rates went even lower.
Mm-hmm.
So of course nobody is going to pay points when you're already getting a rate of 3%. And so it's not been until like the last 3 years when rates have started to go back up and affordability has become a bit more of an issue because prices have also continued to go up as well. And that's why everything that's old is new again. So we're, now we're hearing about points again. Everybody's had to relearn it. And we're hearing about the buydowns again because they've become it's a great thing for a buyer to come in and face it for that first year, have payments that are at a rate that's 2% lower than the market rate.
It's incredible.
Yes.
Yeah. It is a significant savings. And again, it ends up costing the seller a lot less to do this, gives the buyer a lot more benefit than if the seller just reduced the price.
Are there any special scenarios in which someone would be eligible for this, or is this just something that everyone can do? It just has to be negotiated into the offer.
In general, everyone can do it. It doesn't even have to be negotiated into the offer. If it turns out when you get to the point of request for repairs and maybe the seller just wants to give a credit, which they often do, if they give enough credit, we can just say, hey, let's do a 2-1 buydown. And they're able to do that. Now, not every loan type allows it. Conventional allows it, FHA, VA, those are all good, and even some jumbo, but not every single loan will allow a 2-1 buydown.
Okay, so if we're trying to get a hold of the 2-1 buydown situation, we would talk to you before actually employing that as a strategy.
Definitely,
Okay.
yeah.
Yes, because also the 2-1 buydown is also based on the loan amount and the rate. So either one of those changes or both, the credit that the seller would give the buyer would change as well.
Okay.
So very important to talk to your.
Yeah, I mean that, like when we're working with clients together, we're like talking every day. It's like we're talking about every single strategy to make sure that the client can be in the best case scenario as possible.
Yes.
And once we get through all of these details, then we can actually move forward with the sale, and it's a lot of
And
communication.
then just perfect escrow.
Easiest escrow ever.
Well, and it's just like so many people, so many agents don't understand VA.
Mm-hmm.
And it's just because they've never done many.
Mm-hmm.
Maybe whether they're working with the buyers or the sellers, they just don't understand. And whatever you don't understand, you stay away from.
Mm-hmm.
Yes.
You avoid it. And, like I said, to me, VA is the best loan out there. And if someone is eligible for it, it's awesome. And there's no downside for the seller. But a lot of agents are thinking about the old days where the seller had to pay a bunch of the closing costs and there were all kinds of issues. And it's just not like that anymore.
Yeah.
So I think a lot of what we do and a lot of what you do is all education.
Yes.
Yeah. Amazing. That's what we're here for.
Yep.
So you guys, thank you so much for coming and doing this with me. There are so many special things that we learned. It's really incredible. And having you guys on the client side and just constantly ushering them through the escrow process and before is just so important. can I be a little silly and ask maybe a very basic question, but why would anyone work with you guys versus any other lender? What's the benefit here?
Well, Lynda's amazing.
We know that.
Yes. Absolutely amazing.
As are you, Darlene.
Oh, thank you.
One reason that they would work with us, not only for the purchase, but also then later on, as we've talked about, possibly refinancing, is because we are always there. We are monitoring their loan, because just like you, our service to them does not end at close of escrow. And so we're monitoring their loan, and if it looks like the math makes sense for them to refinance, we will proactively reach out to them, and if they refinance with us, we will also waive our only lender fee, which is $1,695. That's all that we charge. The other fees that are involved are all third party, and so third parties don't let us waive their fees.
And I want to add, it's only within the first 3 years that you purchase that we offer this.
Well, that's highly valuable, because
Yes.
those are the years where you're still holding on to that relationship and constantly checking in. So
Yes.
you're doing this as a benefit for your clients, because you've already built this relationship, and you're working together to still keep them in the best case possible
Yes.
in their house.
Well, like you, Geena, with us, we feel like they are clients for life.
Mm-hmm.
We want to be their cheerleader, when it comes to their mortgage, because that fits into their financial picture. So we want to be there to be their trusted advisor. And that way, they can always contact us, and we're always happy to explain anything, help them compare options. And, sometimes we might not even offer the best option for them.
Mm-hmm.
We had one recently where we couldn't, but Darlene was like a bulldog, and she found a great option for them with a different lender.
That's impressive.
That's what we're there, just like you're there, is for their best interest.
Mm-hmm.
And that's what we want. So whether it's today or tomorrow, that's the service that we're trying to give.
Amazing. Thank you both so much.
Thank you, Geena.
For anyone who hasn't heard of Lynda and Darlene from Prosperity Home Mortgage, now you have. And I'm so honored and happy to introduce everyone to you guys, because you have been absolutely incredible, and I'm so thankful that I get to introduce my clients to you, and we get to change lives and make people land in their forever homes, and it's what we love to do.
100%. Yep.
Thank you.
Thanks. With your dress, oh God, it's Monday. Words! I know, use your words, Lynda.
Everyone, who are we addressing? Hi everyone, thank you so much for being here. No one's here. I lost my train of thought. This is how it's gonna go.
Oh, that's great. I love this.
I feel confident
Yeah.
now. You said it so much more eloquently. How did you?
And now you want me to remember.
Yes, and she will. Yeah.
It is complicated, but then people can just watch this YouTube clip
Right.
and they'll know it.
Right.
Perfect. We did it.
Yeah.